Welcome to Stress-Free Investing Analysis, Personal Notes. Today, we're unpacking the absolute tug-of-war happening right now with Avenue Supermarts. You probably know them better as DMart. Before we jump in, please take a quick look at the CB disclaimer up there. Just a quick reminder, I am not a CB-registered research analyst or investment advisor. Everything we're going over today is strictly for educational purposes, based on public info and my own personal notes. Always do your own research or consult a professional, okay? Let's get into it. Section 1. The Tug of War. DMart's valuation is completely dividing the market. Seriously, this is officially the most polarizing stock we've looked at in this entire series. Just look at this wild split. We've got incredibly smart analysts violently disagreeing on where DMart is headed. On one side, you've got CLSA screaming high conviction outperform with a massive target of 6,628 rupees. But then on the exact opposite side, Citi is slapping a bearish sell rating on it, targeting just 3,650. So what's driving this massive canyon of opinion? Let's figure it out. Moving on to Section 2, the unbeatable business moat. To really grasp this debate, we've got to look at what made DMart a 3 lakh crore behemoth in the first place. It all traces back to the legendary Radhikesh Andamani. The guy is famous for being uncompromisingly frugal, right? And that DNA is built right into DMart through a model called EDLC-EDLP. That's everyday low cost, everyday low price. It's basically a permanent philosophy. They negotiate at massive, massive scale. And get this, they pay their suppliers in just 11 to 14 days. In the retail world, that is lightning fast. Because they pay so quickly, suppliers give them huge early payment discounts, which DMart then passes straight to us, the consumers, as permanent 5 to 15% savings. No flashy gimmicks, no weekend-only sales, just permanently low prices that make customers incredibly loyal. Now, here's the real kicker. They own 90% of their real estate. Think about what that means. Sure, dropping 30 to 50 crore upfront to buy land and build a store is a huge pill to swallow, but their ongoing rent? Literally zero. Meanwhile, their competitors, like Reliance Smart, are bleeding 3 to 8 crores every single year just on rent per store. By owning the dirt they build on, DMart locks in a permanent margin advantage of 1.5 to 2.5%. It's a structural cheat code that is practically impossible for leased competitors to replicate. And they're just executing this flawlessly. In FY26, they crossed a massive milestone, 500 total stores. They literally added 85 stores in a single year. That's a record-breaking pace. But hold on, Section 3, the quick commerce threat. If they're so unstoppable, what's got the bears so spooked? Well, here's the billion-dollar question. Are 10-minute delivery apps, your Blinkits, your Zeptos, your Swiggy Instamarts, permanently eating DMart's lunch in the cities? The bears argue that urban middle-class shoppers are permanently shifting a good chunk of their grocery spend, maybe 20 to 30%, just for the convenience of top-ups, like getting milk or bread in 10 minutes. But the bulls, they hit back saying, look, DMart is for bulk. You're not buying a 20-kilo bag of rice on Zepto. The argument is that quick commerce just can't serve that planned monthly household stock-up efficiently. And you can literally watch this tug-of-war play out in their same-store sales growth, or SSSG, which is basically the heartbeat metric for retail. Historically, DMart cruised at a 12 to 15% SSSG, but then a slump. It dropped to a pretty sluggish 5 to 7% through most of FY25 and FY26, which definitely fueled the bear thesis. But then came Q4 FY26. Bam! A massive 10.8% recovery, best in 3 years. This really points to their strategy of pushing into Tier 2 and Tier 3 cities where quick commerce is practically a ghost town, actually paying off and neutralizing the threat. All right, let's pop the hood. Section 4, financial health under the hood. We need to see how this brutal operational battle is actually showing up on the balance sheet. Okay, at first glance, this is going to look a bit scary. Their gross debt absolutely exploded, jumping from 312 crores in FY25 to a massive 2,270 crores in FY26. That's a 7x jump. But wait, remember that real estate moat we talked about? This debt is entirely for buying appreciating land for those 85 new stores. It's not a sign of a struggling business trying to keep the lights on. Their overall debt-to-equity ratio is still incredibly low at 0.10, so it's aggressive compounding, not a liquidity crisis. And you see this reflected in their financial scorecards. Their Altman Z-score, which measures bankruptcy risk, is a sky-high 35.17. That is deep, deep in the safe zone. Now, you might notice their Piotrowski F score is a bit middle of the road at 5 out of 9, and the Beanish M score is throwing a bit of a warning flag at negative 1.9. But honestly, they are financially rock solid. These flags are just popping up because swallowing the upfront cash for 85 new stores temporarily messes with short-term efficiency ratios. It's just the price of owning your own expansion. But here's the catch, and it's a big one. The stock is trading at an 89 times PE ratio. At 89x, the market is pricing in absolute, literal perfection. Zero room for error. It assumes margins recover, SSG bounces back completely, and the quick commerce threat just vanishes. That is a very, very steep premium.
So where does that leave us? Section 5, Bull versus Bear Case, the verdict.
When we weigh the uncompromised business model against the quick commerce threat and that sky-high valuation, our probability-weighted fair value comes out to 4,105 rupees. That's actually a bit below the current price of 4,413. Because of that, this is a pretty clear hold for right now. If we assume even a partial recovery in store sales, our base case puts the stock somewhere between 5,000 and 6,000 over the next 2 years. The smart play? Hold it if you've got it, and look to accumulate on dips if it falls below 3,800, where the valuation risk cools off significantly. If you're keeping tabs on DMart, write these down. Q1 FY27 same-store sales growth is your absolute binary trigger. If it comes in above 9%, the bulls win. Below 7%, the bears take it. Also, keep an eye on EBITDA margins. We want to see them stabilize at or above 7.5%. Watch like a hawk to see if Zepto or Blinkit start aggressively invading those Tier 2 and Tier 3 cities. And finally, look for their capital expenditure to taper down to around 2,500 to 3,000 crores so their free cash flow can turn positive again.
Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed companies should I analyze next? Drop the stock name in the comments below and it might be the subject of my next explainer. Thank you for watching and keep your investing stress-free investing.